So unofficially, and again, don't quote me on this, but unofficially, and the IMF doesn't have to report it, and Saudi doesn't have to report it, what we're seeing with the flows is probably, and I can't confirm this, so I'll caveat that, at least 45 to 50 tons of Saudi gold has been sold since the war started. Again, not because they want to, but because they're forced to. So these forced sell-offs are really temporary headwinds, obviously, for gold.
When you have a crisis, you need money immediately. You look at things that are highly liquid, that's gold. You also, frankly, look at things that have gone up. So if your target for gold was 10% and you bought 3 years ago and it's now 20%, well, that's natural that you sell that asset to bring it down. And that's exactly what Turkey is doing.
Gold is experiencing short-term pressure as crisis-driven liquidity needs prompt, unexpected selling, including by major holders. Recent estimates indicate that 45 to 50 tons may have entered the market, not due to a change in long-term conviction, but because nations require immediate access to dollars. During periods of financial stress, gold is often sold first because it is highly liquid and has appreciated in value, particularly when allocations surpass targets after recent gains. These factors create temporary headwinds that can lower prices, even when underlying demand remains strong. MatthewPiepenburg, a macroeconomic strategist, and AdrianDay, an experienced global investor, explain that these forced liquidations are usually short-lived. Once liquidity pressures subside, sovereign accumulation and structural demand typically return. This shift signals that gold's broader outlook may improve, as the current weakness serves as a reset before the next phase of growth amid ongoing currency and geopolitical instability. We now present selected clips from their interview. Before we continue our discussion, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I've never been more confident, and none of us at Von Greyers have ever been more confident about gold's longer-term direction, and that's not just an apology from Zurich and a gold vault, and a private gold vaulting service, but I understand skepticism. You know, for me and many others outside of the gold space, again, especially those in the bond markets who understand credit risk and currency risk, gold really is real money. And central banks have been seeing this. Pre-1971, central banks held 70% of their reserves in gold until Nixon welched on the Bretton Woods system. Today, gold is only 30%, and it will get to at least 50%. Gold is, up until this war, becoming the de facto primary reserve asset. It's the new FX reserve currency, 40% US dollars, 35% gold. We saw central bank gold stacking go up 5x since 2022 when we weaponized the dollar in the last war. We were a proxy war win with Ukraine and Putin. So there was clear de-dollarization trends, there was clear gold stacking trends, and those trends aren't going to stop. But we can't deny what has happened since this war began, this black swan or gray swan, or some would say white swan event. You can't deny that there's been massive sell-offs in gold. We need to explain what's going on, put them into short-term and longer-term perspective without sounding like an apologist. The war sell-offs, and again, this is in the background of, gold loves chaos. What could be more chaotic than the headlines today? Why isn't gold at 6,000 or 7,000? It will be. But why isn't it right now? And this is what I call the great paradox, where you have to sell good assets like in a margin call in a stock market crash to pay for the sins of your bad assets. So you sell your most liquid and valuable assets. That's not just an apology or a dramatic statement. The numbers are there to show it. I use a couple of examples. Turkey, for example, which has been stacking gold religiously in the last few years since we weaponized the dollar against Russia, just sold 10% of its gold in Switzerland. It just did a swap. Now, a swap is kind of like a pawn shop. It's swapped. It means it can come back and get it later. They can, it's kind of like putting grandma's jewelry there and then hopefully getting it back. But they just sold 10% of their gold swaps in 2 weeks. That's 60 tons of gold they swapped. That's greater than the 43 tons of all ETF gold sold since the war started. So why is Turkey, which loves gold, having to sell its gold? Well, sadly, it's because 90% of Turkey's oil and gas is imported. And so when you have ripping oil prices because the Strait of Hormuz is clogged, every $10 increase in the oil price is another $5 billion in costs for countries like Turkey. So they have to sell their liquid most valuable asset to create enough dollar reserves to buy petrodollars. This is how the petrodollar is the tail that wags the dog of the rest of the world. So that's an example of a major sell-off in gold. Of course, that's going to push the price down. The other interesting example I use is Saudi Arabia and the other Gulf states. Obviously Saudi Arabia and the OPEC or GCC nations have a lot of oil, but they also have to import 80% of their food. Their military costs are rising, and a lot of expats with a lot of dollars are leaving those zip codes because of the missiles flying. So there's a major drain of their dollar reserves. And since they cannot get new reserves, they have a lot of oil, but they can't sell the oil right now, and they can't get the same revenues. So these countries, our allies, again, never be an ally of America, have to replenish their dollar reserves because their dollar revenue is clogged. So unofficially, and again, don't quote me on this, but unofficially, and the IMF doesn't have to report it, and Saudi doesn't have to report it, what we're seeing with the flows is probably, and I can't confirm this, so I'll caveat that, at least 45 to 50 tons of Saudi gold has been sold since the war started. Again, not because they want to, but because they're forced to. So these forced sell-offs are really temporary headwinds, obviously, for gold. Obviously, also, at Von Greyerz, we're all about wealth preservation. Our clients are all about wealth preservation. It's all about long-term thinking and recognizing that paper currencies, including the dollar, are just melting ice cubes. In the long run, gold always gets the last laugh. When gold was ripping into the end of 2025, I say a lot of tourists came into the gold space and they wanted to trade the momentum. So they're buying a lot of ETFs, which is the last place you should own gold if you're into wealth preservation. And when they were buying these ETFs, they were typically buying 2 to 3x levered ETFs because they were speculators. They weren't wealth preservation thinking. I understand that. They saw a momentum trade. They wanted to get in. They wanted to lever. When gold was ripping, those leverage trades and ETFs made them look very smart. But when gold corrected during the war, be careful who's over levered because those ETFs have to rebalance daily and cover their margins. So there's a massive sell-off in the ETF space. The other place where there's not wealth preservation thinking, but speculators are hedge funds. And they were trading on algo trades, riding the gold momentum until this war. When they get a sell signal, they all sell en masse. They're not there to preserve. They're there to make profits and swing trades. So all of these things combine to be a real temporary but real, headwind to gold. For those who understand gold as a wealth preservation asset, as literally life insurance for dying currencies, these are just buy signals. And our smartest clients are picking up the phone and buying more gold into these markets because they're thinking 5 years, 10 years out. And again, I can get into a ton of different data points on gold ratios to the money supply or the gold price versus foreign held U.S. treasuries. We are not even close to all-time highs in gold. We're 50, 60% off. And these pullbacks are just buying opportunities. But the other thing is, and I'll end with this point on gold, gold will be revalued to offset debt. Besant himself, even before Trump was in the White House, wants higher gold prices. We don't have the same fear of rising gold as we did in 2011 or 1980 when Volcker said gold was my enemy, or some other said gold was to the dollar like the sun was to vampires. We actually need to let gold run to pay down some of our debts, to revalue gold. I've written about that too. But all of these forces combine longer term to suggest we're only in the second or third inning of gold's bull market. This is not a momentum trade. Gold is a new superior reserve asset. It's a store of value that's better than even the world reserve currency. So these forces right now in the smog and fog and smoke and oil of war are easy to shake out a lot of people. And bull markets always shake out a lot of tourists. And it's sad. They usually get out at the wrong time. We saw this in the great bull market between 71 and 1980 with gold, where midway through in 1975, there was a major shakeout in gold. A lot of people sold at the bottom and then missed the whole ride up. But again, we're not trading gold at Von Greyerz or those who understand physical gold outside of the banking system as a preservation asset. This is a buying opportunity and not a sales pitch from a gold apologist.
Gold's recent decline reflects short-term liquidity stress rather than a shift in its long-term trajectory. When crises occur, even robust assets are sold to raise immediate cash, especially as energy costs rise and dollar demand increases. In this situation, a temporary paradox arises. Gold prices can fall even amid greater uncertainty. Further, additional pressure from leveraged positions and institutional portfolio rebalancing has intensified the decline. These are transitional factors within a broader macroeconomic shift. Beneath these short-term fluctuations, the structural trend for gold remains strong. Importantly, gold's role in global reserves is expanding as confidence in fiat currencies declines, leading central banks to steadily increase their allocations. Although gold's share of reserves has decreased from historical highs, the current trajectory suggests a gradual return to greater prominence. As these dynamics continue, the current weakness is likely a preparatory phase before a stronger upward move, with gold potentially rising significantly once liquidity pressures subside and long-term demand strengthens. Let's get back to the interview.
The questions that I'm getting and still getting, and probably that you're getting, is, gosh, with a war in the Middle East, why isn't gold moving higher? A lot of people expected gold to move dramatically higher with this conflict in Iran. And, you know, it's interesting. There's a couple of, a few things I'll say, if I may, because I think it's worth spending a bit of time on this. I did a kind of study. I guess studies a bit pretentious, but I did a look at how gold had reacted to geopolitical events, negative effects. I'm not talking about the wall coming down or anything like that, but negative geopolitical events, particularly conflicts, military conflicts, over the last 50 years. What is interesting is that as often as not, gold actually declines very shortly after the conflict begins. Now, why is that? And that's not unusual. In the majority of cases, gold declined shortly after the military conflict began. Russian invasion of Ukraine is a perfect example. And of course, Iran is a perfect example. So why is that? Well, the first thing is that these events rarely come out of the blue, right? The Iran hostage situation in 1979 or 9/11, you could argue they were completely out of the blue. But I don't think anyone could argue that the Russian invasion of Ukraine was just, oh my gosh, I wasn't seeing that coming. Or Iran. We were speculating about whether Israel and the US would attack Iran for at least a week, but for weeks. And the crescendo was building. And gold reacted. So in the 8 days before the bombing started, gold was up over $500. So and then of course the Monday after the bombing was actually the peak, and then it fell since then. So it's number one, it's a question of buy the rumor, sell the news, which happens in all sorts of markets all the time, right? It's not unusual for a company to have good earnings and the stock goes down. You say, why was that? Well, it was because everyone was anticipating better than expected earnings, if that makes sense. Investors can expect better than analyst expectations, right? So buy the rumor, sell the news. That's number one. The other thing that's critical for people to think about is, in a geopolitical event, yes, gold is a safe haven, but there's another safe haven asset, and that's the dollar. Now, if you look at the last 3 months in the build up to the invasion in the build up to the bombing and then afterwards, gold has been an almost mirror image of the dollar. So as soon as the bombing started, the dollar, I'm looking at my screen now, excuse my eyes going, the dollar started moving up. It's a mirror image. So that's another thing to remember. And of course, not only did the dollar go up, but yields around the world went up for reasons we can't get into unless I'm talking for too long. So you had the yield on US Treasury bills now being very, very competitive with gold. And so, gold fell for those reasons. But the third reason to think about is that typically in a geopolitical event, there is a liquidity crisis. It may not be global, it may only be regional, but of course, a regional liquidity event can still have an impact on prices. Prices, as they famously say, are set at the margin. So in this particular conflict, you had gold selling for large, or let's say significant discounts in Dubai and the rest of the Gulf, because people were wanting to dump their gold You know, if you're in Dubai with your family, you may stay, but you want to get your family out. Maybe if the whole family moves, you say, well, do I really want to keep my gold in Dubai? Let's just sell it, buy the ticket at the exorbitant price and get out. So you had this rush for liquidity. And frankly, if Iran is bombing different places in Dubai and not being particularly accurate with their missiles, who knows whether my storage will blow up at some point. So there was a rush to liquidity in the Gulf area. And gold always takes a brunt of a rush to liquidity because it's an asset that's immediately liquid 24 hours. Well, it's got a price 24 hours a day. It trades 24 hours a day. You know, it's immediately liquid. And I think that's another important factor that people overlook. Now, talking about the rush to liquidity, we also now know that Turkey, it's now, last week it was reported not just 60 tons, but about 120 tons was sold by Turkey to defend the lira. And they were defending the lira because of the conflict in Iran. If there had been no conflict, they wouldn't have had to sell. Well, like most people, when you have a crisis, you need money immediately. You look at things that are highly liquid, that's gold. You also, frankly, look at things that have gone up. So if your target for gold was 10%, and you bought 3 years ago and it's now 20%, well, that's natural that you sell that asset to bring it down. And that's exactly what Turkey is doing. But let's really think about this. 120 tons, which is the last number I saw that they sold in March, that's to sell that all in the space of 2 weeks is meaningful when all central banks around the world only, I use only in quotes, let's not say only then, they bought 863 tons last year. So that's on the course of a whole year. So to sell 120 tons in 2 weeks is clearly a very significant event. Now, I would say when that news first came out, originally they said 60, then they moved it up. But when that first came out, the market immediately took a bit of a dip. But I said, whoa, wait a minute. This is actually positive. Now we know why gold dropped so much, right?
Gold's subdued response to geopolitical conflict reflects a recurring pattern that often surprises investors. Prices tend to rise before events and then decline once the crisis unfolds. This buy the rumor, sell the news phenomenon has occurred across multiple conflicts, with gold incorporating risk before headlines reach their peak. Simultaneously, a stronger dollar and rising yields create short-term competition for capital, diverting investment away from gold despite increased uncertainty. Liquidity stress is another significant factor. In regional crises, gold is often among the first assets sold due to its high liquidity and ease of conversion to cash. For example, large-scale selling, including reports of central banks offloading over 100 tons in a short period, can temporarily depress prices. However, when forced selling concludes, these episodes often reveal the underlying strength of demand. The broader implication is that such declines are not signs of weakness, but components of a larger cycle in which gold resets before continuing its upward trend amid ongoing global instability. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.